Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, November 5th, 2018. This one will be quick. I just want to share a few levels and more importantly, share my thoughts. And my thoughts are this. I'm still in a somewhat of a wait and see mode. If I have pretty strong convictions, I'll usually let you know. And this more so to the subscribers of the right side of the chart. The trade ideas I had planned to add back a lot over the last week or so, and I'm holding off. I'm holding off for a couple reasons. I believe in quality over quantity. I know that works against the model of most subscription services where you want to see trade ideas on a constant basis. Um, my goal is to share what I see and what I'm doing. I'm keeping it light right now. I've made mention dribbling back the other day, a couple, last Friday, going back in a little bit, scaling back into the semiconductors, and here and there. And of course, I'll still do active trades. But as far as swing trades go, um, I'm still not convinced where we go in the very near term. And the only thing that I hate worse than losing money on a trade is getting into a trade that's dead money, a sideways trade. And I'd like to see a little more or have a little more conviction that the markets are either going to go down, take that other leg down that I think is possible, and I do still think is coming here in the fourth quarter, and that could come start tomorrow, an impulsive move down, or it could be after a couple weeks of rallying or at least even trading sideways. So I wanted to share those thoughts. And the other thing is, after a big market move and a big profitable, run, we had a lot of shorts, and I know some people on the site did very well. I did very well on this last leg down trading, and then even gaming some longs on the bounces along the way. But Warren Buffett, we were talking about him. I mentioned him earlier in the video today. How Berkshire has decided to deploy a lot of their cash on hand now instead of in new investment opportunities, deploy that back into stock repurchase because they obviously don't see a lot of great deals out there right now in the market. But so speaking of Warren Buffett, one of his famous sayings, he's got a lot of sayings out there in the markets is as far as making money in the stock market, rule number one, never lose money. Rule number two, never forget rule number one. So I like to live by that because I can just tell you from my experience, I've some of my biggest losses have come on the heels of my biggest gains, and that's from over trading. When you have a lot of gains, all your trades are hitting it one after another, whether the market's going up or down. You have a profitable run when you have this volatility, and what that, at least for me in the past, has led to is over trading and over position sizing and overconfidence. That all goes hand in hand. When you're overconfident, you take more trades, you take larger position sizes. So if any advice I can share or what I do personally and doing now is keeping it light, because like I say, I prefer not to try to give back any profits right now at this point in time. And you can see too, the market, this is a 60-minute chart of SPY. It's sort of trying to figure out where it wants to go. And I have my theories of how many sellers are still trapped in here, or potential sellers. But remember, we had a heck of a correction. We've come down to overbought levels on the daily chart. We're right here. We're looking at a 60-minute chart. And the market may or may not need to work off, digest those oversold conditions, and either in the form of a sideways trading range or maybe a little more upside. That's certainly a possibility. I can still see keeping the bearish case well and intact, a move all the way up to 279.50 on SPY. I think that's a pretty important support level. But here we are right now. So I'm just watching things trade. You can see the SPY is sort of sandwiched in that range I just boxed in there between 275 and 270 on the downside. And that's the other thing. When I wanted to sit back and see how things shook out today. Early on in the morning, right after the markets open, I saw a big disparity. QQQ and the NQE mini futures dropping down. I saw the Qs, or at least the futures, down over 1% earlier, and I believe the Qs were as well, while at the same time SPY, the S&P 500 tracking ETF, was comfortably in the green. You don't see that often. So what that shows me, and I took a look, you take a look under the hood, the S&P 500 is really the stock market. It's much more indicative of our economy, because you have 11 sectors spread out there. So you have representation of a lot of companies, whereas the NASDAQ 100, although it's my preferred trading proxy, it's very tech heavy. Over half the companies are tech. You don't have any financials. You're lacking certain key sectors in the economy. And this was how the S&P 500 closed today. These are the 11 sectors. These are their tracking ETFs. And you can see, nice gains in energy, REITs, financials up 1.55%, utilities, the consumer staples, healthcare, industrials, basic materials. So the only things down today was tech, and tech actually had a pretty decent recovery at the end of the day. The tech sector closed down just 0.9%, and XLC, the new communications sector ETF, was the weakest one, down zero point 0.4. So you can see, point being, 9 out of the 11 sectors were up. So that tells us it was overall the market, the stock market itself did pretty good today, despite a red close in QQQ. But again, that is because QQQs, the top weighted components, are those two sectors that were down, technology and the communication sector. So I'll give you my opinion on the charts here. This is a 60-minute chart of QQQ. I cleaned it up a little bit, took away some of the other lines that we had from before. And you can see right now there seems to be a pretty decent level where we had failed out on Friday, which was also the support zone I showed you earlier on the NQ and ES E-mini futures. But it's about 172.44 so far. And from a pure technical perspective, putting aside what I think the market may or may not do, this doesn't look half bad, because what I see here is a downtrend line right here. This was the golden downtrend line, by the way, which I nicknamed the golden downtrend line during the last several weeks, where we had a lot of failures there. And then both on QQQ and SPY, the golden downtrend line was taken out. We rallied into resistance. You can see that resistance was support back here, finally broken, was resistance once again there. So it was a pretty well-defined level. We failed there, but all that has done so far is come in to back test that trend line from above. So two things happened today. We had a back test of the golden downtrend line, a successful one at that, meaning we tested and we bounced off it. And we also had a partial gap fill. Here we go. I wanted to get a clean board there. What I'm referring to is the recent big gap from last Wednesday right here. You can see the gap up. And SPY has successfully defended that gap so far, the top of the gap. You have resistance, or once you're above a gap, there are support levels at the top of the gap as a natural support level, and the bottom of the gap. Very often, but not always, once a gap is entered, it's backfilled. What happened with QQQ, it dipped its toe into the gap, but it managed to close right back above there today. So it's holding gap support so far. And SPY, on the other hand, has successfully defended its gap as well, the top of the gap. Doesn't mean that we're those tops of those gaps can't be retested or taken out. But as of now, they are important support levels to look at. So keep an eye on that, that level on the SPY, as well as QQQ. If the gaps are entered, especially if SPY starts coming down now after already successfully testing the top of that gap once, my expectation would be for a breakdown below, probably get a backfill or possibly more. Let me say this. Everything I've said over the last few weeks, all the pounding the hedge funds and pension funds and individual investors have taken, and I can still see it. And that's why today, my common theme, I put a post out earlier, it's still that unwinding of the FANG trade. Look, Apple was down big today. Amazon had another big down day. Those are where the institutions and individuals are top heavy. And so you're still seeing that distribution. They're taking any strength to sell into. Now, yes, that's not strength in Apple, not strength in Amazon, but the broad market was up. Those stocks would have been a lot worse had the market moved down, SPY and QQQ, had they dropped even more today. So you can look at it two ways. Maybe there was a lot of retail buying and inflows coming into Apple and Amazon, but the institutions are still unloading. We can try to analyze it all day long, but the common theme here is those big overweighted stocks that lifted the market up to the crazy levels that we were at recently are the same ones now, and especially on the way down recently, that have held it back. So we can't rule out anything at this point. I can't rule out more upside, but in the near term, like I said, I'll just watch this. If we see an impulsive move down, as I said this morning, if we smash through the bottom of these gaps, we go to backfill them, and then we have a very little, maybe a minor reaction or nothing at all. We just slice through the bottom of those gaps right there and continue down. I think the farther we go down, as we approach these recent lows, if this were to happen very soon, I want to get this out there now, before it happens. I don't want to do a video after the fact. My thoughts are if we start to take another leg down soon, the closer we get to these lows, the greater the chances that selling will begin to accelerate. People will start to panic again, and then we could get that big flush out move I'm talking about and another 10% or so downside. But as long as we're here, there are some constructive things that I'm seeing in the charts. And we could certainly hold up for a while or even continue higher to some of the other support levels that I showed you a minute ago, including that 279.50 on SPY. What else did I see constructive? Well, we can see the PPO on the 60-minute chart of SPY. I like to use the 9 EMA, which is a signal line, the white line, as a trend indicator. And when that white line, which is it's the dotted line here, when it's above the zero line, the trend is bullish. And when it crosses down below, like it was here, as long as that line is below, the trend is bearish. Very often the zero line, which is the dotted line here in the middle, acts as support or resistance. So we had it come up here, test that zero line, might have popped briefly above it, but failed. So it pretty much told us from this point to this point, the trend was bearish. However, we had a bullish cross recently. Just like we were above trend over here, that trend indicator was bullish. It is now bullish, and you can see the PPO line turning up here as well. So that's that coupled with the recent breakout here. Again, we had a breakout, gap away. We've held the top of the gap on a back test. All in all, I can't knock this 60-minute chart, and I have to give this to the bulls. And this is really formulates the near term. Like I said, long-term charts are still telling us a different story right now, and that's why you have to be skeptical of how far these rallies can play out, or how far this bullish pattern can play out. QQQ, similar story as far as that trend indicator. There's the 9 EMA signal line. We've had a little bit of whipsaws. Of course, I always say that with trend indicators, when trading is sideways, they don't work very well. They work much better when you have some pretty clear trends or volatility like this. So we broke down here. We went on a sell signal, had a little whipsaw there, but for the most part, it said the 60-minute trend or intermediate term trend on QQQ was bearish. But recently with the breakout right here, we also had that trend indicator move back above the zero line. And you can see it is still, the white line is still above the zero line now, with the PPO line also curling up right at the zero level. So if this can hold up, if the futures hold up tonight and we can open up flat or higher tomorrow, we might have a successful back test here, keeping the trend in the near-term trend bullish, come up and make a run for 172. We'll call it 172.50. From there, let's see what happens. That's also an objective shorting op. Like I said, long-term charts are bearish. We can turn down at any point now. The market doesn't mean the market can't recover. If the market can really rally up here, get us back above a lot of those long-term trend lines, and there's still some that haven't given way. I've pointed that out in the past. We've had a lot of long-term trend lines on the weekly charts break, some key moving averages, but they're not too far ahead. So I'm not trying to confuse you here. I'm just trying to tell you that this is still anybody's game, at least here in the near term. But if you start to see us go down, these trend lines give way, that gap is backfilled and then some, we start heading down. Is another test of those lows possible? Absolutely. Let's look at one scenario here. I'll give you both sides of it. There's the 60-minute divergence, which was in place at the bottom. So let's say QQQ does make a run down to take another test run at these lows, whether it undercuts them slightly or reverses above. There is a potential to keep these bullish divergences intact and set the stage for an even larger rally. Let's see how that would look in SPY. Yeah, same story. You can see I can extend the divergence lines out, and it all depends on how any pullback looks. Bigger picture, let's not forget that. So far, we failed here at the 200-day moving average. But like I said, we've held that gap. I think I just showed you that on the 60-minute chart here. SPY has successfully held last Wednesday's gap on several tests so far, and we're still above it. So this is just indecision, these candles here in the sideways trading. But bigger picture, you have a lot of overhead resistance, 279.25 or so right there. You have the 200-day moving average. I mentioned the bullish crossover here recently on the daily, but then again, as I go out to the weekly charts, they look pretty bad. And that still tells me my preferred scenario, if you want to know, forget about the next few days, what's going to happen in the next week or so. I think at best, and that's again at best, we come back and back test these trend lines from below and then roll over. Um, and at worst, maybe we just any one of these days we start a big down day and the selling kicks off again. And it's fine. I do like to get in front of big moves. Sometimes I'll take a breakdown before it actually occurs or a break out of a bullish pattern before it happens if it looks imminent and likely. However, it's not the end of the world to jump in after you have confirmation. I think that's a safer play. That's sort of what I'm thinking right now, at least with the official trades on the site and a lot of the positions that I closed out recently, a lot of those short trades. Before I get aggressively short again, I want to see the evidence. I don't want to get caught in a sideways grind. And worse than that, I don't want to get, have the market continue to rally and move up and take out these levels. And, who knows, hard to say right now, but uh, pretty much, and I think I've covered this before, my uppermost bounce target um, would be about 178 on QQQ. I think I had it on a couple other charts. I'd really like to see the Qs remain below 178 to keep the longer term bearish case intact. And if they take it out and something changes in the charts, maybe there'll be a trade to be made on the long side, but I just don't see that at this point in time. But again, the charts are dynamic and so is my analysis. I'll wrap the video up by doing this. As I like to say, an index is simply the sum of its parts. In the case of the S&P 500, it's the 11 sectors that I showed you earlier in the video. They're right here. I won't go through each and every one of them because some stand out a little more than others, but one of the key sectors is the financials, about over 13% weighting in the S&P 500. So here's my XLF chart. Forgive me on this one. It's quite busy, and I have a lot of different lines. I'll try to just show you here what's important to me. 2691, give or take. We'll call that 27 if you want, round off. That to me is it was a pretty important support shelf or support level before. We had resistance right here. Finally, we broke out. We came in after breaking out. We back tested it right there. Here, let me use the circle tool. We back tested it there. We back tested there for several weeks. Back tested again with a slight undercut. Remember, there's been some volatility in the market. So some of these tests might have pierced on an intraday basis or maybe 1 or 2 days. We broke it there, but then regained it again. And you can see once we gave it up, we broke support there. So another way to look at it, all of this price action from late 2016 throughout most of 2018 so far, that was a possible topping pattern. It was certainly an area of consolidation or a trading range, and you can see we broke down below it, back in early October when when the selling really got underway. You can see here's the initial move down. We came back several occasions, back tested it and failed, had another leg down. Now we're back testing, so I wanted to point this out. This is a significant resistance level. Support once broken becomes resistance. Doesn't mean that we can't take it out. And like I said, I can show you, I can drill down to the 60-minute charts. I can make a bullish case. And it all comes back to what I was saying before. If this is something more, if this was just the initial leg down, and I'm talking not just the financials, but in the entire stock market, if this was the first leg down in a much larger correction and or bear market to come, then you would expect a lot of bullish, 60-minute patterns and little crossovers like this on the PPO, oversold readings to be very fleeting buy signals. That is the nature of a larger correction or bear market. So you have to be on guard because at any one of these levels on any day you can reverse. However, maybe this was like what we saw early in the year, just a run-of-the-mill 10% or so correction, and we're going to continue higher. But right now, this one looks different for a lot of the reasons I've covered recently, and you can also see if you zoom in here, a lot of the key moving averages are above prices right now. I have on this chart, some of these are tuned down, the 200-day, 50-day, and 20-day exponential moving average. The 200 and the 50-day are much more significant. They're both just overhead, right above this 2691-ish resistance level. So that's XLF. Let me pick another couple ones. Here's XLP. Again, I should clean up this chart, but what stands out is right here we had this uptrend line. We had a divergent high. At that point, we had a heck of a correction after we broke down and back tested this uptrend line. And more recently, we put a marginal new high, and it's a divergent high. We punched above this 55.41 level I had. It was the old highs, but you can see that simply extended these divergences. And these are your defensive stocks, consumer staples. Even though they tend to hold up better during a bear market or recession than growth stocks, they do and can fall with the broad market. They will go down. And during a bear market, just about all the sectors in the S&P 500 fall. But the defensive issues like utilities and consumer staples tend to fall less. So keep that in mind that this one is now still within close enough proximity to that resistance level there, and also has a big negative, big negative divergence there. Not a huge sector in the S&P 500, but one worth mentioning. Healthcare, hard to knock this. It fell down recently, came down, held the 200-day moving average, bounced off that so far, as well as this 86.62-ish level. Potential bullish cross in play, hasn't happened yet, but close. Positive divergence down here on the RSI, but we'll keep an eye on it. Industrials, I wanted to mention this one. You have a trend line right here, pretty significant trend line, comes off the early or late 2016 lows. Actually, no, it goes to the left of that chart, so maybe even beyond that. And that trend line is just overhead, as is a lot of resistance. So I'm seeing really a common theme. If you just box this in, and again, I know that's a busy chart. Here's a clean board for you. Let's look at that. Okay, so again, just look at this area of consolidation. Looks like a potential topping pattern. And whether it is a major topping pattern or not, you can't argue that it is a significant area. It's well defined. You can see all the reactions down low. In fact, I should have took that box all the way over here to the left, include these reactions here. So we popped above it, but by a relatively small margin. Remember, volatility's been high. It is not unusual. In fact, it should be expected that key support and resistance levels, moving averages, everything else may be overshot briefly. So we're not out of the woods yet on that. We may still fail, but it could go the other way. So let's watch that. These are the things I'm watching. The more we can get back above and into these levels, the more it helps the bullish case. And should we start to be rejected off these, and again, the XLI is just one of several sectors, but it does make up almost a 10% weighting in the S&P 500. One of the bigger ones here is consumer discretionary. And this chart should give pause to any bull out there right now, anybody that thinks the market's going higher. This one is again, it is a pretty big sector, about over 10% weighting in the S&P 500. This yellow trend line is a multi-year. This is a almost 4-year-old trend line. It goes back to early 2016. Very well defined. I know I have a lot of annotations on this chart, but you can see all the reactions up here along the way. Well-defined trend line in XLY. I'm going to zoom back in a little bit. So we broke down. We reversed just shy of my first target there, 99.84. It was actual support. This wasn't an official trade. That's my support level. And now we've come back and we've hit this 107.45-ish resistance level, as well as that uptrend line, as well as a 200-day exponential moving average. It's that red line. You can see it right there. So this is Amazon, really. Amazon is 1/3 of this portfolio. So, and Amazon, and we all know, is been in trouble lately. So this is a key level and a key sector to watch, because this makes up a good part of the S&P 500 as well as the NASDAQ 100. With a big weighting in Amazon there. So there's that. And finally, technology. All along, as the market was walking up, we saw the S&P 500 breakdown first. We saw the QQQ backtesting, and I continued to reiterate, when tech breaks, the market breaks. And then tech finally broke. When did tech break? This was it. And this was our confirmation that correction would be underway. When XLK finally broke down from this bearish rising wedge, came on down, kissed this secondary trend line, had a brief pop, gave it up, back tested. I mean, this is traded beautifully to the technicals. These were levels that were in place beforehand. Hit $68, which was support, bounced all the way back to that trend line, came back down, hit my next target here, bounced. But so far, and again, this is the biggest sector in the S&P 500 at 21%, and it is by far at around 60% the biggest in the NASDAQ 100. So this is, of all the charts I just went over right now in the sectors, this one by far is most important. So what do I see here? We have this clear breakdown in that 200-day moving average, exponential moving average, which does a bang-up job for tech stocks especially. that was support and has defined this uptrend for several years now, has capped all the pullbacks, including those back earlier in the year when we had those two big corrections. But now we're back testing, and so far we've failed one, two. There's a daily pop above and close, but you can see the next day we failed it. That's what I'm talking about, this volatility and these overshoots. So there's a failure so far. We had a bullish PPO crossover, but it looks like not yet a rejection. The lines haven't crossed back down, but they're flattening out. So watch this one, and if we go back down, obviously this would be, well, 69.08, or call it 68. 68 should be our next support. We kissed it today, closed back above it, almost lost it intraday, but gained it at the close. So watch that level, really watch today's lows. If they get taken out, we come back down here, test that 65.30 level again. And if that doesn't hold, like I said, I think it'll be over quick. I think the bunch of sell stop orders will be triggered again, stop loss orders, shorts will pile in, and then we'll come down and either test those earlier 2018 lows, or maybe even undercut them slightly, but somewhere in there. And again, to try to quantify that for you, I think it's still about, I've said it before, about a 11% or so drop. So that's what I'm looking for. And like I said, this week could prove to be pivotal. There's some bullish developments that we've seen recently, especially on the intraday charts and some of the stuff here on the daily charts. But if they foil these, just keep an eye on those key support levels I talked about. And if we start to see another waterfall sell-off, I guess the point that I'm trying to impress is it may not be too late to jump in, if the market is down 2 or even 3% one day. It depends what you're trading, what you're shorting. Ideally, you want to short. If you are looking to short, you want to short bounces back to resistance like the 200-day or a price resistance level, or you want to short a break of support. Those are the two objective ways. If you're long, you're looking to buy dips, well, or get in long, there's two ways you want to go long. You want to go long on a pullback to support, or you want to go long on a breakout above resistance. So let's say we take out that 200-day with conviction and close above it. Again, you need to take this in context with everything else. I wouldn't trade XLK in a vacuum. I'd be looking at SPY, some of the other sectors, many of those market leading stocks, because they're also in precarious technical postures. So you're going to get a little bit more whipsaw signals on a lot of these sectors. And that's why I try to take everything in, what all the indexes are doing, what all the sectors are doing, a lot of these key stocks. And right now, because I have those some mixed signals, or a little, it's a little bit unclear in the very near term. But again, that can change on a dime. And if it does, I'll let you guys know. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.